What's up? Today we'll be micro-analyzing the differences between ETFs VGT and FTEC. I say micro-analyzing because these two ETFs track the same index and are thus very similar. We will break down the holdings of the index, the overlap, the cost of each ETF, the performance of each, and we will discuss the pros and cons of sector investing. If at any point you decide you like this video, feel free to hit the like button. That's what it's for. Without further ado, let's get started. VGT is the Vanguard Information Technology ETF. It has been around since 2004. It has $44 billion in assets under management and an average daily volume of $154 million. FTEC is the Fidelity Information Technology ETF. It has been around since 2013. It has $5 billion in assets under management and an average daily volume of $31 million. So while FTEC looks young and small compared to VGT, it's still considered very large and liquid. Both of these ETFs are sector ETFs that track the MSCI US Investable Market Information Technology 2550 Index. Sector ETFs allow you to invest in an entire industry without having to piece together individual stocks in that industry. VGT currently trades in the high $300 range. FTEC currently trades in the low $100 range. This really only matters for those without access to fractional shares. Now let's take a look at portfolio composition. VGT currently has 332 holdings, while FTEC has 351 holdings. So technically, FTEC is slightly more diversified, but I say that mostly tongue-in-cheek as again, these are both ETFs that focus on one sector of the economy and are thus inherently non-diversified compared to broad market index funds. 50% of the holdings are software and IT services, 22% are technology hardware, 18% are semiconductor companies, everything else is under 3%. A little bit of communication equipment, electronic equipment, machinery equipment, and also renewable energy. Let's run through the top 10 holdings. We have Apple, Microsoft, Nvidia, Visa, MasterCard, PayPal, Adobe, Intel, Cisco, and Salesforce. Keep in mind if you are looking for tech names such as Amazon, Alphabet, Tesla, and Facebook, these technically do not fall into the tech sector. They fall into consumer discretionary and communication services. Perhaps the biggest difference to note here is that Apple is currently 20% of VGT and only 19% of FTEC. This isn't that important, but what is more important to note is that Apple and Microsoft together make up 36% of the index. This is a significant concentration risk. If you like Apple and Microsoft, no problem. If you don't, then maybe you should find another ETF. Digging a little bit deeper, we also have other names such as Broadcom, Qualcomm, Texas Instruments, AMD, Intuit, Square, and also Zoom. American companies make up 99% of the index. 83% of companies are large cap, 13% are mid cap, and only 3% are small cap. Let's take a quick look at exactly how much overlap we have between these two ETFs. 95% of VGT's holdings are in FTEC. These two ETFs overlap 98% by weight. This table tells us which holdings are overweight or underweight in each. Most of them are off by 0.1, 0.2%. This source says that the Apple difference is 0.4%. Next, let's take a look at cost. Usually trying to beat Vanguard on cost is like bringing a knife to a gunfight, but Fidelity has done just that. VGT has a net expense ratio of 0.1%. FTEC has a net expense ratio of 0.08%. Actually, it's 0.084% if we want to get super technical. So $1,000 in VGT would cost you $1 per year. $1,000 in FTEC would cost you 84 cents a year. So nothing to worry about with cost here. In fact, if you sort by the lowest expense ratio and the highest 5-year returns, both of these ETFs are at the top of the list. So both of these ETFs are dirt cheap and the difference between them is minuscule. So it's not like anyone with gains would want to take the tax hit of selling VGT to move to FTEC over a tiny difference in cost. Speaking of tax, let's talk about the tax efficiency of both of these ETFs. Both of these ETFs have an annual turnover ratio of 5%. So this is nice and low, which is to be expected as these are both passively managed ETFs. Turnover ratio is a measure of how often assets are bought and sold by managers. It is calculated by taking either the total amount of new securities purchased or the number of securities sold, whichever is less, over a particular period, and dividing them by the total net asset value of the fund. This is usually reported for a 12-month time period, so less turnover means less taxable events. And this gives us a better chance of holding longer and paying the more favorable long-term capital gains rate, which you get by holding for more than a year. Tax cost ratio measures how much a fund's annualized return is reduced by the taxes investors pay on distributions. The tax cost ratio of VGT is 0.24%. The tax cost ratio of FTEC is 0.23%. So a very slight win for FTEC, but both are nice and low. As far as dividend yield, VGT has a slight win with 0.72% compared to the 0.7% with FTEC. Again, these are small differences that tend to fluctuate, so I wasn't kidding when I said microanalyze. But looking at the bigger picture, a modest 0.7 dividend is about what you would expect from growth-focused tech companies. You don't buy these ETFs for the dividend. But getting back to our last topic on cost, let's take a look at the spread. Spread is the measure of liquidity and the cost of trading shares. Essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically, the larger a fund is and the larger the trading volume, the lower the spread. As we mentioned earlier, VGT is the larger ETF, therefore it wins on spread. The average spread for VGT is 0.02%, the average spread for FTEC is 0.03%. Again, both of these ETFs are large and therefore they have tight spreads, and this is a very tiny difference. But if I were a trader, I'd still pick VGT as traders tend to value higher liquidity and lower spread. As a long-term buy and hold investor, it doesn't matter much either way. For our last segment, we look at performance and how efficiently each ETF tracks its index. Over the last month, VGT has a slight win on performance. Over the last 3 months, FTEC wins. Year to date, VGT wins by an ominous 6.6%. 1 year, VGT wins. 3 year, VGT wins. And VGT wins over 5 years by a margin of 0.29%. And again, FTEC hasn't been around for 10 years, so we don't have a 10-year comparison. So while VGT has performed slightly better over the last few years, it is by a very small amount, and we can't really say anything about which will be better moving forward. But I do want to take a second look at the average 10-year annual returns for VGT of 21%. This is incredible over such a time frame. The two only non-leverage ETFs that have done better over this time frame are semiconductor ETFs SOXX and PSI. To put this into perspective, Warren Buffett has averaged 20% annually since 1965. If you invested $1,000 a month for 40 years at an annual return of 20%, after 40 years you would have $89 million. So obviously this would never happen, but hey, a man can dream. This just shows you the power of compound interest, and it certainly speaks to how strong tech and growth has done for the last 10 years. But this is of course no guarantee of future results. The last thing we will look at is tracking difference and tracking error. These are measures that judge how well an ETF tracks its index. They depend on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Tracking difference shows how well a product's performance compares with that of its benchmark over a stated period of time. It is a good report card for how well a manager is doing. It is calculated as the fund's net asset value total returns minus the benchmark's total return. It can be positive or negative depending on whether or not the fund outperforms or underperforms its index. Given that fees are included, tracking difference is typically negative. The 12-month median tracking difference of VGT is minus 0.25% compared to a minus 0.15% for FTEC, so a win for FTEC. Vanguard is typically competitive in that metric. Tracking error indicates the consistency of a product's tracking distance during that same time period. It is the annualized standard deviation of tracking different data points for the given time period. The tracking error of both these ETFs is 8.28. This is a pretty normal tracking error. In general, tracking difference is more important for a long-term investor. Tracking error can be more important for a short-term investor. So what's my opinion on these? Who is the winner? The answer is that it's a tie. So I know that's a terrible answer after such a long breakdown, but most of the differences are small and they tend to fluctuate either way. I think both of these ETFs are great ways to get low-cost, diversified tech exposure. I will say I personally own FTEC. I guess the slightly lower expense ratio makes me feel better or something. Given two ETFs that track the same index, I will usually go with a lower expense ratio unless I feel as though the other factors outweigh that benefit. I will say Morningstar rated VGT 5 stars and FTEC only 4 stars. But FTEC is still 5 stars in my heart. Also, both have an A from FactSet. But a more important decision than which one to buy is whether or not you buy one at all. There is certainly a concentration risk associated with owning a large portion of your investment portfolio in one sector, regardless of what it is. It is tempting to go all in on tech, given how well it has done recently. But conventional wisdom tells us to own the entire market as opposed to picking and choosing sectors. And again, past performance is no guarantee of future results. Growth tech stocks are also particularly sensitive to interest rate hikes. So while these stocks have benefited in a time of declining rates, there's concern that they will go back up. I know many people use these sector ETFs as trading instruments to time in and out of sector rotations, but I would never trust my ability to do that. I just buy and hold. Typically you underperform when you try to chase returns. But I'm definitely guilty of being overweight in tech and innovation. I'm a firm believer that innovation is the driver of growth. But what do I know? I'm just some guy on YouTube. But if you found any of this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your cryptocurrencies. As always, this is not to be considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.